Bandhan Mutual Fund presents MF Corner.
Hello and welcome to the special edition of Mutual Fund Corner, the YouTube edition. And we are at the start of the financial year and most of us make those ELSS investments towards the end to get the tax benefit. But should you do that or should you start it at the start of the financial year itself? I have an expert joining me today, Abhishek Kumar, founder and SEBI registered investment advisor at SahajMoney. Abhishek, thank you so much for joining us today. A pleasure having you on the show. And as I mentioned, we are at the start of the financial year and ELSS investments, usually people do that towards the end to get that tax benefit. What is your take? When should it be done?
First of all, thanks for having me in your show, Sonal. Looking forward to an exciting session today. With regard to the question that you just asked, it's a good question to ask. ELSS is a good option for availing Section 80C tax benefit for investor who are looking to, let's say, use the limit of 1.5 lakh, and that is not going to be, let's say, exhausted during this financial year through using their, let's say, contribution towards provident fund or insurance premium, etc. So that's a good option to begin with for the tax saving purpose. Also, I would always suggest one to check their own risk appetite and then decide an asset allocation into equity, debt, and other asset classes. And for the equity, long-term equity allocation portfolio, I would suggest that they can consider ELSS fund if they're looking for additional tax benefit, as I just explained, especially if they're not going to use this money for the next 3 odd years. For a different set of investors whose, let's say, ATC limit of 1.5 lakh is already getting exhausted or about to get exhausted during the year, or who is not looking to lock their money for the next 3 years, I would suggest they can skip the ELSS. Yeah.
Okay, so the timing doesn't matter if it is at the start or at the end. How does one go about it? Because I've seen a lot of people, doing it in January or February. That's when you start getting those mails from the human resources team.
That's one of the way of looking at it. I would suggest doing it in a systematic investment plan. More so if they're not sure of the liquidity or they do not have the liquidity to do this lump sum allocation at the start of the year. And it's very difficult to time the market, as you know, being a part of this market for a long period of time. So I would suggest if that is not the case, you have a liquidity situation, do a monthly SIP for the portion that they have available of the Section 80C limit over a period of time. And that way they can avoid the risk of timing the market.
Makes sense, because as you said, one cannot time the market. We are in a time where there's so much volatility already. Abhishek, you did speak about the risk appetite, the asset allocation, but is it good or prudent to have more than one ELSS fund if one's risk appetite does allow it? How many ideal funds in the ELSS category should one have in their portfolio?
So there are two parts to it. One is, equity fund are not stock investment that they're not diversified enough. You know that equity mutual fund have at least, let's say 22, more than that kind of stocks. So, and a bit of diversification that provides enough diversification. So the argument for, getting into one particular fund is not the same argument about having a concentration risk of investing in one stock. And for the investors, as I just explained, who are planning to invest into ELSS for tax benefit, I would recommend investing in one fund instead of many. As anyway, purely for tax saving purpose, they would not be able to save more than 1.5 lakhs per year for Section 80C tax benefit. So if they break it down into monthly SIP, then it comes just to around 12.5 odd thousand SIP every month. So that doesn't leave out too many funds to experiment with, too much of money to experiment with. So they can just focus on one fund. What they can do is essentially look at the rolling period return instead of point-to-point return before deciding a fund. They can compare the return for 3, 5, 7, or 10-year period, and then identify one of the fund that they wish to invest with for their, let's say, tax saving purpose for ELSS fund.
Okay, makes sense. So you did indicate the returns, right? The rolling returns that one can look at. How have the ELSS funds performed so far versus the benchmark?
So based on the data that we analyze, I would say reasonably well, Sonal. We had SahajMoney have compared the 3-year rolling return of 8 ELSS fund. What we did is we went and identified 8 funds which have completed more than 25 years in existence against the Nifty 50 as a benchmark, and found that most of the time the rolling return of these 8 funds for a 3-year period have been better than the Nifty benchmark. In some cases, few basis point, in some cases, to a larger extent. One possible reason for this could be that the 3-year locking period that ELSS necessitates. Sonal, you would already know that the SEBI's data point show that 50% of mutual fund investors quit before 1 year and nearly 84% before 3 years. This is the data that SEBI released last year for FY23. So looks like ELSS does these investors favor by locking them in for 3 years, so they don't have a option of quitting it before that period.
And that helps the returns. So you mentioned that 3-year locking period. What should an investor do after that? Should they continue once the lock-in period is over, after tax benefits have come by?
Investors should compare their equity MF return against the benchmark along the need for their liquidity before redeeming the investment. So let's say again, I go back to the point that I discussed in the previous question, that they should compare the rolling period return and then decide whether the return have been good enough for them, and if they don't need the money, they can just continue to stay invested. Else, if they find that the returns have been poor as compared to the, let's say, the benchmark that they are following, they can reinvest the money in other funds, equity or debt, based on their asset allocation needs.
Okay. So it really depends on what the performance has been over a period of time for ELSS funds. Abhishek, what are some of the risks that you see with ELSS funds? Of course, the benefit is tax exemptions that you get. But if someone does invest in ELSS, what are some of the risks that they have to go through?
See, one thing is that if a fund or a set of funds have performed better than benchmark, doesn't mean that they will not have negative returns in a 3-year or 5-year or 7 or 10-year period. So, like in our analysis, we found that out of the 8 funds that we discussed a few minutes back, 4 out of these funds could give a negative return in some period of time. This could range between a probability of, let's say, 0.1% to 10% to some extent. So to give an example or analogy, just like if we say that a river is 4 foot deep on an average, doesn't mean that a 6 foot person can't drown in it. As the river might be 2 feet deep in some places and 12 feet deep at other places. So if you start with an assumption that, oh, this is just a 4 feet deep river and I being a 6 foot person can quickly walk through it, you'll get into trouble. Likewise, there will be periods when a ELSS fund can give negative return. So if you don't have an appetite for the same, then you can simply avoid it and invest in other safer avenue for the tax saving purpose.
Okay. And the lock-in period also, do you think that is something that keeps investors away from this category?
To some extent, I would suggest that it's not a major factor. People, if they do the due diligence, understand that what is a lock-in period, and have an incentive to, let's say, save on taxes because they have exhausted the rest of the resources, then, in our experience, people are open to invest because that could be, taking away their money for a long period of time, say 3 years. They would understand that, they don't need this money for the 3-year period. So that's why they are investing into it.
Got it. There has also been an introduction of passive ELSS schemes. What is your take on that?
It's a good point. Yes, SEBI has brought a circular to that effect in May 22, as you know that currently, but there are only 3 funds so far which have done that. And SEBI brought additional clarification that if, let's say, a fund house has already have a active ELSS fund, then they didn't need to discontinue that. Then only they can start a passive ELSS fund. So there are not many funds which have done that. Out of the 2, out of these 3 funds, 2 have, are tracking their, let's say, performance against Nifty 50, but their expense ratio is quite high compared to the expense ratio of the index that they are tracking. Let's say in this case, Nifty 50 index fund. It's probably because their AUM is quite less. In both cases, it is less than 100 odd CR. So I would say 2 year is a too short a period. Hence, we do not have enough data to compare it against benchmark return. I would wait for some time for the performance to emerge out of this and then compare it whether holding this investment as a mandatory 3-year lock-in is advantageous, and then if they can do it through a passive ELSS against a ELSS fund, which has a higher expense ratio.
Yes, and the passive versus active debate keeps on going, right? And now there's another category that's been added to it. Abhishek, thank you so much for joining us with your thoughts on ELSS funds today and when one can invest and what goes according to their risk profile and asset allocation as well. Thank you so much for joining us today.
Yeah, thanks for having me. I'm looking forward to seeing you again.
Okay, all right. With that, we'll take your leave on this edition of Mutual Fund Corner YouTube edition. But stay tuned for more news and updates.
Bandhan Mutual Fund presents MF Corner.